So welcome to the Seattle Angel Conference workshop. We're doing a workshop around deal terms. This is not sort of a 101 version of deal terms. This is, come up to the book about deal terms and take a hard left and talk about alternative deal terms. And out of that, we'll build a little vocabulary. And so maybe one of the things we also might want to have is a vocabulary area where every time someone says a word that you don't know what it is, write that word down under vocabulary so that we can sort of keep track of that and help people go with that. So let's see. I see Looney here. I see Hall here. I am not yet seeing Bryant. There's Bryant, but Bryant has no face. So we have 3 speakers tonight. I'd like them to go into a little more detail about what kind of investing that they're doing and how they came to this conversation of deal terms and sort of set the frame a little bit. And then we'll dive into exactly how the different models go. And I'd like to start with Looney first.
All right. Hey, everybody. My name's Looney. I do a whole lot of things. But in this context, we'll talk about what I do at Fledge. Fledge is it's a business accelerator. It's based on the model of Techstars, except we made 3 changes to it. First change is we don't care about tech. We're an impact investor. We care about solving the real problems of the world. One way to talk about it. Second thing we changed is we shortened it up because we're not a hackathon, nor are they anymore. So it's a 2-month program instead of 3, not a huge change. And the third and most important part is we changed the way we invested. So the way that accelerators work is they provide usually $20,000 to everybody who comes in, every company that comes in. And in exchange for all the money and all the help, the typical number is 6%. So the accelerators take 6%. And Techstars and Y Combinator and all these thousands of others generally follow that same model, as do we. And then in the case of Techstars and Y Combinator and everybody else in tech, they then wait for someone to buy the company and they cash out when that acquisition happens or when some IPO happens. Quick version of this is I was looking at how to run a program in a market that doesn't have such exits. So if you look for the companies that are actually solving the climate problem or solving poverty, for-profit companies that are doing that, you don't find a whole lot of history of exits, right, and acquisitions. And so I needed another model. And I looked and I had an aha moment. This is back in 2012. And I had remembered a board member. I'm a serial entrepreneur. I used to be a techie. I had a bunch of VC-backed companies. And one day in 2010, one of my board members from Voyager Capital, Eric Benson, came into the board meeting one day, super excited. All he wanted to do was talk about this other company. So we obliged him. And it was the latest investment from Voyager Capital, and it was called Lighter Capital. I think at the time it was called Revenue Loan Company. And he didn't tell us how they came across this company or any of that, but he was all excited about the way they were investing. And I filed that away because it was totally irrelevant to my life until 2-3 years later. And bam, that was the kernel of the answer on how do you invest in any startup anywhere in the world, regardless of whether there are exits or not. And we'll go into how that works in a bit. How's that, John?
That was perfect. Thank you so very much. Hall, could you please do something similar?
Sure, John. Yeah, thanks for having me. My name's Hall Martin. I run 10 Capital. We're based in Austin. And my background is I started 3 angel networks in Texas back in the 2000s and started to really learn about, deal terms and how you put these together. And what I discovered is, and you'll hear this in many angel presentations, is that, 1 out of 10 deals is a 10x home run. 2 are going to be medium, 1.5 to 3x returns. 1's going to go under, and then the other 5 were just going to go sideways on you. And so the challenge was trying to find that 1 out of 10 deals to be a home run. And my experience is that I actually invested in startups, and after a couple of years, 2-3 years, it starts to become clear which way it's going. It's continuing on the venture track up, or is now going sideways. And so I came up with a model called 3X and 3. It means you get 3X your investment at year 3, or you forego that redemption right and go on the cap table as an equity investor, and we use a convertible note. And we'll dive into that in more detail here in a minute, but fundamentally, I'm not making my decision on day 1 when I write my first check. I'm making my decision at year 3 as to, do I want to be an equity investor, or do I want to be a debt investor, or a combination thereof? And so it gives me a chance to see how the company performs, and it gives me the opportunity to make a decision later that matches with what the company wants to do. And we'll talk about that more in the terms and how you actually put that together. We use redemption rights, and that's a key factor. Redemption rights are not often used in early stage term sheets. If you go look them up on the web, what you'll find is that they're typically used at year 5 in some term sheets for getting your initial money back, and that's it. But as an investor, I don't want to be in the deal for 3, 4, or 5 years and just get my money back. I want something of a return. But that's how we work, and looking forward to sharing that term sheet with you here in the next section.
Cool. Thanks so very much. And then we have Bryant, and Bryant is a last minute replacement for Joe Wallen, who's feeling ill. And he is part of Joe Wallen's team that worked at Carney Law around the creation of a fund called Ernest Capital. And so, Bryant, I have 2 pathways that I want you to sort of highlight. One is the conversation about the seal and what the seal is, but also a little bit about the rolling fund mechanism and how that might be different than the normal way we set up an investment structure. So
sure.
Could you introduce yourself? Cool.
Would you like me to go right now?
Yes, please.
You might lead in for me, John. It was so great. So, yeah, my name is Bryant, and I'm a corporate attorney in the Carney Badley Spellman Emerging Companies and Venture Capital Groups. And yeah, so I guess just to get right into it, we can start with the seal agreement. Now, I don't know how many of you have previously looked up Ernest Capital and some of the stuff they've done. And if you haven't, really recommend going and having a look. The founder of Ernest Capital is a guy named Tyler Tringus, and he's a really interesting guy who has done a lot of writing online about, not only the different types of vehicles that they have explored and used, but also he has some pretty strong opinions and takes on the venture capital industry and, how investing, in his opinion should be done. So, he's a good resource and some interesting reading, between his Twitter account and then just a lot of the blog posts they put on Ernest Capital. But Tyler came to us a couple years back, and he really wanted to explore an instrument that was different than kind of what was already out there. And, Looney previously mentioned Lighter, who is another client that we helped build the kind of agreement suite for, or rather Joe did. Years back when they were getting started. And so that's kind of the revenue loan structure. Now, that's a little bit more unique, and it's something that Lighter really kind of paved the way for in a lot of ways. The other instruments that I'm sure you guys are all familiar with, or at least have heard of, is Convertible Notes, as being one possible way to kind of do a really early stage investment. Another one is the SAFE. And, really we look at SAFE and oh, sorry, I was getting some feedback. I thought someone was trying to say something. Really we look at safes and convertible notes as kind of the same class of early stage investment. I mean, they really are pre-subscriptions, in my opinion, for someone's eventual fixed price equity round when you're selling Series C or Series A. So, Tyler was looking at kind of the standard fare of agreements that are out there and, being a bit of a contrarian, wanted to try something different. So what he ultimately wanted to do was to take the general concept and ease of use of the SAFE, which is why everyone uses SAFEs for the most part. I mean, they're, kind of peddled by Y Combinator. Everyone's heard of them. It's openly available online, and they're relatively simple documents to wrap your head around once you understand the structure. He wanted to take that kind of one size fits all, easy to understand document, but build in some different economics that he felt was better aligned with, you know, the types of investments that founders were looking for, specifically people that are kind of more bootstrap type founders and maybe not traditional use cases for VC. You know, the idea is that there's this kind of chasm that exists between the ideal target that, you know, Hall was kind of talking about, where it's, you know, these 10x return, potential unicorn, home run sort of investments. And then this other group of investments that are going to maybe do those 2x or 3x returns, but, you know, in the traditional VC model is kind of viewed as a suboptimal outcome. And so what Ernest wanted to do is try to create a document that took pieces from some of the other available documents out there, but was really going to be catered towards that kind of group of companies that may not be attractive to traditional venture capital because they might not be that 10x company. So what ultimately was the result of that was the seal, which it started off as the name, and it was something like shared earnings agreement loan kind of thing. Basically, there was a huge marriage to this, you know, initialism or this acronym seal. And ultimately, the way the document kind of evolved, it didn't really make sense to use that anymore, but we were already kind of married to the name, so it's still the seal, even though it doesn't really make any sense. But anyways, the seal is a document that basically takes, at its core, it's a safe and kind of is trying to do some of the same things. You know, it's not debt, it's not a convertible note, there's no maturity date, there's no interest. You know, there's none of those kind of classical debt terms. That's really the distinguishing factor between a safe and a convertible note anyways. But what it does retain is valuation caps and discounts and basically these conversion terms for, you know, basically this pre-subscription that you give money, and then eventually under this instrument, it's going to transform into the fixed price round when that eventually happens. But the kind of the tweak on it is it overlays in some revenue sharing type economics. So Ernest or Lighter is, you know, the traditional kind of revenue sharing company, and their revenue always be top line revenue. So, you know, usually it doesn't matter, you know, what your expenses are. So to the extent you have top line revenue, that's where Lighter is going to kind of slot in and see their economics. Alternatively, what Ernest has done is said, you know, we understand that a lot of these companies are going to be early stage startups and probably not turning a profit, and they want to align with the founders. So what they have done is they have gone in and basically the way they calculate the income that they essentially share with is it's net income, but there is add backs for founder salaries to a certain threshold. So the idea is, you know, Ernest or the other company that's utilizing an instrument like this in the company and the founders will agree upon what they think is, you know, a salary threshold, and that includes bonuses and other kind of performance incentives with the founders, and then sets a level for that. And then what happens is the net income then that the revenue sharing terms attached to is a combination of the net income of the company as well as any sort of payments to the founder beyond what they've agreed to as kind of that base threshold. So the idea is, you know, they're not going to juice the company immediately and kind of take that money out of the founders' pockets. They want the founders to pay themselves some sort of mutually agreeable salary, and then, you know, kind of participate in the economics after the founders have, you know, essentially felt like they're getting a good return. So beyond that, you know, I don't know how familiar you guys are with revenue loans, but how they typically work is there's no interest rate. There is something called a repayment cap. And usually what that concept is just, you are going to let us participate in your revenues until we hit, you know, some preordained cap. And usually it's some multiple of the investment amount. So it'll be, we're going to participate in your revenues until we hit 3x the amount we invest. And, you know, that's really kind of the boiled down version of how the revenue loan portion of it works. You know, going back to how this kind of integrates with the safe. Now, there's the revenue aspect, but this agreement has aspects of it that are also convertible into equity, which is where it kind of goes back into safe land. And how it does that is it utilizes this thing called an equity basis, which is a formula that looks at basically the greater of the repayment cap, which is that multiple on the amount invested, or just the base investment amount. And like a safe, in certain instances, this agreement can kind of be wiped out and just converted into equity at the election of the investor. And how it works is it looks at the equity basis, and then in the event of a fixed price financing, it converts very convertible note or a safe where it's looks at a valuation cap or a discount on shares, and then the holder of the note or the seal may elect to convert this instrument into the equity round that they're converting into. And in that instance, this entire arrangement goes away, and they'll immediately cease making the revenue sharing payments once they're converted, and they become just like any other stockholder. There's also other conversion terms, like say in the event of a liquidation scenario or a sale, where they essentially will convert into the amount that they would have converted into had they converted into common at like a valuation cap, or if they were just going to do the repayment cap. So I realized that was kind of a blast of information, and I know this was kind of maybe an introduction to some of these instruments, and this is a weird one, but really it is just a blend of a revenue sharing type arrangement and a safe. So you've got the sharing of the top line, or just sharing of revenues with the company in a way that Ernest believes is more founder friendly. And then underneath that, you have basically the classical safe conversion terms. And they also have a number of other kind of elements in here that you guys will see a lot of, I'm sure, where it's, participation rights, the right to invest in future rounds, there's board observer rights, there's financial inspection rights. So just kind of other spiffs that are usually, if you're say investing on a safe, included often in like side letters and stuff like that, but it's all kind of built in to this single agreement. So I realize I prattle on for quite a bit about that. Does anyone have any questions or anything? And feel free to interrupt me as I talk as well, just with any questions you have.
Sorry. Most of the frameworks that we've talked about all have a revenue component, and they think about revenue in different ways, or they have a prepayment mechanism. So in order to just sort of ground this for people who have not been in a deal before, can I ask you, Bryant, to sort of talk about what does a standard convertible note look like in terms of the core knobs that I can adjust? I've agreed that I'm not buying the preferred stock, and the reason that I'm doing that is because I can't figure out the price in a reasonable way. So I'm gonna do this other thing. What are the knobs on that thing?
Yeah, for sure. So kind of the first aspect of a convertible note that you're going to look at is the debt terms, or the kind of classic loan terms that you can think of. So that's the maturity date, that's the interest rate, and that's the principal amount. So, usually in a convertible note, like John said, you're investing in a convertible note or safe because there's just not preferred stock available, and preferred stock's not available for usually a myriad of reasons, but oftentimes with really early stage companies, it's because they have no idea what they would price their preferred stock at. They need a little bit more time to operate and mature. So a convertible note has some debt functionalities, and there's a question of, how much in terms of like interest would you expect on a convertible note? And usually it's lower than what I would say you'd expect in like a commercial lending type situation, or even like a venture debt situation. Most of the time the debt terms are supposed to be a little bit more company friendly, because really, no one goes into a convertible thinking that they're going to make money on the interest income or anything like that. You go into a convertible because you're assuming that you're going to eventually convert into preferred stock. So, and really convertible notes are kind of structured in such a way that, depending on the form that you use, they're not always necessarily the best debt instrument. At maturity, you might be able to call in debt, but oftentimes, right, with early stage startup, there's really not probably that high of a chance for you foreclosing upon the assets of the company. That's going to be office chairs and MacBooks and some IP that, you may or may not be able to drive without a management team. So, so that's kind of the first kind of piece of the convertible note. The second piece is the conversion terms. And the conversion terms, the two flavors that you usually see is a discount on the price per share that's eventually offered when they do establish a price for their initial fixed price round and then go out and sell it. So usually you'll see that represented anywhere from like 15 to 30%. I would say generally you see 20% discounts on that price that the new investors in that round are going to pay. That so as a note holder, when you convert and you convert your principal and interest, in the case of a note, you're going to get the benefit of 20% off the price per share that the new money investors are getting. The other mechanism that you use for conversion in these instances is the valuation cap. And a valuation cap kind of serves as a ceiling on runaway valuations. You know, if you can go and get a really, really low valuation cap as an investor, that is usually always going to benefit you, because any valuation of the company above the cap is going to most likely result in a much better price per share the discount would yield. And so essentially what the valuation cap says is, you know, hey, so let's just say, for example, you have a valuation cap of 10 million bucks. What it says is instead of saying, you know, when the company's deciding what they're going to price their round at, they're like, all right, well, we're valued at 20 million. We feel like we're a $20 million company. Our capitalization is, you know, this. So by looking at our capitalization and the value of the company, we can establish one price per share. And what the valuation cap does is essentially says, okay, well, hear you that you say the company is worth 20 million, you have all your investors lined up and they're ready to buy at that price. But we've established that for the purposes of generating a price per share on this note, 10 million is what we're going to say treat as your valuation, because that was the cap that we established. So what it does for an investor and how it's usually used, or how it's intended to be used, is to serve as a kind of a ceiling to prevent against a company that, you know, you invested in very early, it becomes very successful and has some huge astronomical valuation that may or may not kind of price you out of getting the amount of shares that maybe you should be entitled to because you were an early investor. So it serves as a ceiling on valuation. And yeah, I mean, beyond that, there's a couple of other terms that you'll see in convertible notes. You know, a lot of it deals around what happens at maturity. You know, there's the classic idea that at the maturity date, you can foreclose upon the assets of the company and ask for your money back. You know, the other options, as opposed to, you know, going after the assets, is you can optionally convert sometimes into common. So there's oftentimes a mechanism that's usually based on the valuation cap that says, okay, we don't necessarily need you to have preferred stock. We can elect to just take common stock in the company at the valuation cap. So that's another thing that happens around the maturity date. And then, you know, I think that's kind of the core mechanics, John. I mean, there's other aspects that you can see in these things, but I'd say that's kind of the core distinguishing factors for a convertible note.
Right. And for the Seattle Angel Conference, our default offering is a convertible note because we assume we can't figure out a price. And we have just added a revenue redemption clause so that when we hit the term, we have a choice between extending the note, going to a Series C preferred, or going to a revenue redemption, something like what Hall is structuring, in a sense, you know, trying to solve that same problem. So I want to dive in with you, Hall. I muted you earlier, so yeah, good, thank you. I would like you to sort of dive in. You know, you're an angel investor. You could do a preferred round, or you could do a convertible note safe-like thing, and you found neither of those successful. And so go a little bit more into why they're not the right answer for you as an angel investor, why you came up with this 3x3 thing.
Sure. So typically what happens when you're raising funding at the very early stage, you don't have enough revenue to really set valuation. And you don't want to, as an entrepreneur, set that by yourself, because that can be hard to sell to investors later. So you just come up with a convertible note, interest rate, discount rate, valuation cap. And you'll find that there's a fair number of investors that just want to be in the deal, but they're really not going to spend time on it. So they're going to just hand you a 50K check and just be in the deal. And convertible notes work great for that. My rule of thumb is when a 100K check writer comes in but wants equity, well, that's the person we're going to sit down and work with as a lead investor. You just don't know if the lead investor is going to be the first one in the door, the fifth one, or the 25th in the door. And so we like to capture interest from investors through convertible notes with the intention that it converts to equity when you find a lead investor who will come in and price the round, either on this one or the next. And so convertible notes are really what I call a launch technique. It just launches you and gets you going. But the goal is to, at some point, set the valuation, but somebody's got to sit down and do the work. And a lead investor is putting in 20, 30 hours doing research on it, and their number has to stand up to follow on scrutiny by other investors. So they want to do it right. If they put in $100,000 or more, in my book, that means they're probably going to do a quality job. And so that's why we use convertible notes to kick it off, because in the very early stage, you just can't set that valuation by yourself, and other people aren't going to be spending time on it. So once we kick off with a convertible note, it's really meant to be it's a debt instrument that's meant to convert to equity later. If you want debt, pure debt up front, you just go use a promissory note, not a convertible note. So convertible notes are meant to convert at some point into equity. And like Brian said, there's an interest rate, there's a discount rate, and there's a valuation cap. If you ever sit down and do the math on it, you'll find that the interest rate and the discount rate have very little impact on your return. It almost all comes out of that valuation cap. And so the challenge I found is that when I got into deals, many of them were going sideways after 3 or 4 years. And I can always tell when they went sideways because the market rate salaries that the entrepreneur was taking went from below 20% market rate to 150% above market rate. And what that signaled to me is that they were no longer on the venture path. The venture path means you're raising funding every 18, 24 months, you're growing sales, doubling year over year. And some deals go up to 5 million or 6 million, and then they start to go sideways. Some deals go up to 10 million, then they start to go sideways. At some point, most deals don't make it all the way up to a true venture exit, 10x plus return. They end up turning into what I call a lifestyle business. And so I invested in a deal in Austin. They were doing IT asset deployment. They did great for the first 3 years. And then the CEO came to me and said, our employees worked hard. I think they should all go to market rate salaries. And I thought to myself, that sounds right, but wait, that's wrong. Why is that wrong? Well, in an equity arrangement, what you have is an implicit agreement that the entrepreneur is going to live on ramen noodles and take a high salary, and the investors are not going to take profit share or dividends out, all to make the business a very large exit. The moment the entrepreneur decides that they're just going to take a bigger cut out of the salary, that's when the deal is now going sideways and the investor and the entrepreneur are misaligned. The investor's on the equity side and they get paid out when you sell the business, and the entrepreneur is now on the payroll side and they start to take money out more quickly. And so I saw that happen over and over again. About half the deals I saw go through the angel rooms, that's what happened. They just go up a ways and then they go sideways. And you can be in these deals as an investor for 7, 8, 10 years or more with no exit. If the entrepreneur is getting a great salary, hey, why stop this? This is going great. And have seen very poor returns from many of those deals. And so I came up with a model that I implemented a convertible note with a redemption right that at year 3, under investor sole discretion, that means every investor gets to make their own decision. They can decide to exercise the redemption right, and now the company owes you 3x. And essentially, we turn that into a revenue share agreement from there forward. Or we forego the redemption right and we go on the cap table for whatever the original investment was based on the valuation cap. And so you have your choice at that point. Everyone makes their own decision. I tell the entrepreneurs who take this that when you get to the 3-year mark, you should escrow money up to that point to pay back at least the initial investment. I tell the investor, don't expect 3 extra money at year 3 in one day. You expect maybe your original investment back, but the rest will be on a revenue share agreement, which will take 6, 12, 18 months. It just depends on how much. I find that most investors take some portion of it in equity. They don't want to, just take it all out. This could be the next Facebook, and who wants to be on a redemption right with that. So the point is that you can do many different things with it at year 3. I find most entrepreneurs are very negotiable. 70% of them want you to leave your money in and continue to grow the business. 30% hope you take the money out because they want the equity back. They don't want to go through the dilution. So you'll find many different things going on. And what's driving it is the fact that, you know, venture economics and angel economics are very different. In the venture world, they've baked their salary into their fund. And so everything has to be a 10X or it just doesn't matter. In angel economics, you don't have your salary baked into your investing. And so you can still make a good return off of a 3X or 4X return. And then I look at the quality of the deals going through the rooms, and 70, 80% of them are not true venture deals that are going to get funded by VCs, but yet they're still good businesses. You can still make a good return. And so that's why I came up with the 3X and 3 is at year 3, I wanted to start making my decision. And the way I tell the entrepreneur this is, I'm doing what you're doing. If you're on the venture track, I'm there with you. If you're exiting now, going on to what I call the payroll track, I'm there. I'm right there with you as well. Because when I invested in that company in Austin, I saw these guys take out probably from year 3 to year 10, they took out probably about $3 million in the form of salaries. And I thought to myself, I want to be on that plan. I don't want to be on my plan with equity. I want to be on your plan with payroll. But, every deal is different, and you don't know on day one when you invest which way it's going to go. But at year 3, you know a lot more about which way it's going to go. And that's why we came up with the 3X and 3, which is fundamentally a redemption right that gives you the choice at your own choice. Doesn't matter what else anyone does. Doesn't matter what the startup does. The investor makes a decision. And I find it changes the dynamic with the entrepreneur and the investor. Some entrepreneurs, when they take the money, they really don't need you anymore, and you don't hear from them unless they need more money. When they have a 3X coming up and you have a choice, you hear a lot more from them. You get a much better engagement with them, because in many cases, they're trying to keep you in the deal, and they're trying to sell you on the future of it for sure. So that's how we came up with 3X and 3. Anybody have any questions about that?
How many deals have you done that way?
We've done about 6 deals so far. We've had one go into redemption, and most of the investors actually went on the equity path. The other 2 that are coming up is going to be more 50-50. Half will go debt, half will go equity on that track. And then the other 2, we're still building up at this particular point.
Okay. And what kind of data collection or ground truthing do you need along the way in those 3 years for you to keep in sync with the company?
Very good question. We all would like to trust the CEO to do the right thing at year 3, but it's trust but verify. And so we actually do what revenue-based funding does. We gain access to the bank account, and we gain access to the accounting system, and we actually pull reports out to give to the investors. Those who are investing with us, we say, okay, I'll give you your monthly statements. And what we're doing is checking to see if they're escrowing funds. How much are you really doing? And we're looking at salary, not to say that we control it, but when people are watching, you modify your behavior a little bit, because they know that at year 3, they could be on the hook for 3X of what they take in. And the other thing is we limit how much money they take on it. I've had some entrepreneurs come in, without revenue, dreaming of, I'll take $1 million, $2 million on that, not realizing that 3X that is going to be almost impossible to pay back. We're looking at 250, 500 for pre-revenue companies, maybe 500, 750 for those with 500K of revenue, because you do need to be in a place you can escrow money and pay it back at some point, because some of it will probably come back. I find most investors want to take at least 1X their money back out at the redemption right, just to make their fund whole. And in some ways, you can create an evergreen fund with that. I've had accelerator programs sign up to use it because they want to just keep their fund evergreen. And so they put a 1.5 to 2X return on it instead of 3. And now they're able to take some money out, put it back into the fund to fund the next deal, and then have still something of an equity stake in the company going forward. So it's pretty flexible in what you can do. In a convertible note, you set the interest rate, the discount rate, the cap rate, and we still let investors set that on their own. But then we wrapper it with our term sheet, which is a convertible note. And then we sign a separate document, which we call the facilitation agreement, that basically says at year 3, we're actually going to be in there every month doing the reports and just monitoring it. And then 6 months from the end of year 3, when the window is coming up, we go to all the investors and ask, what do you want to do? Do you want to redeem or not redeem, or what? And they have some time to think about it. 3 months in front, we confirm. And then we go through the process of working with them. When it comes down to actually redeeming, we actually and the convertible note matures at year 3, so it's truly due. Any debt that's owed, goes into a promissory note, and then we elect a board of directors to sit on it for control. So you have multiple levels of control that go into it, and if the company cannot pay or refuses to come up with a payment plan, so to speak, we exercise consent rights on all cash disbursements. In other words, I'll let you know tomorrow what your new salary is going to be. So not to say we need all those tools, but I find you need some level of control and oversight over the deal in order to exercise on these things.
So we see some questions starting to pop up. Kate asks, how did you get to 3x instead of 2 or 5 or 10?
Because in the angel world and the venture capital world, you're not looking for 10% on your money. What you're really looking for is a 44% IRR, internal rate of return. And that's IRR, for those who don't know it, is return on investment with respect to time. The faster you get paid back, the higher your IRR is. A lot of angels talk in terms of ROI, but that's not really the best tool because that does not take into account time frame. And so if I get 3x my money in 3 years, I've got a 44% IRR, and that puts you in the class that is going to compensate you for the risk that you're taking, because there's still deals that do go under. And that's one difference about this 3x and 3. Some people say, why don't I just go get a loan? Well, if you go get an SBA loan, you are personally guaranteeing that. A lot of startups don't know that. They think, well, the bank gets paid back. Well, yeah, the bank gets paid back, but you guess who collects on the SBA loan? The IRS. And how often are they going to go away? They never go away. Here in 3x and 3, there's no personal guarantee. So there is a risk reward component on that. If you get a deal that truly goes under, you will lose your money. You get a tax write-off, but that's not what we're in the game here for.
Yeah, so I'm seeing Karen has this concern. She doesn't understand why you would want, as a true venture founder, why you would ever take this deal, because you would want to be able to spend all of your money on growth rather than escrowing money away for this happenstance that might happen in 3 years. Why would a founder want to do this deal instead of putting all of their money onto growth?
Because they want to actually, in some cases, they want the equity back. They're hoping you're going to take your 3x and step out, so they don't go through the dilution. They get the equity back. So for some deals, it makes sense to do that. There are some that they probably aren't going to grow all the way up, and there's just a lot of deals out there that are not going to raise venture capital money. They just don't have the venture economics. The market's not big. They don't have the experience. There's a lot of reasons why people don't raise VC money. And so they go to angels to raise money, and then they turn it into a lifestyle business in many cases, leaving the angel without any way out. So there's quite a few people that are in that middle category. If I have a great venture capital level deal, sure, I can go to a VC and get money. But VCs, they don't invest in every deal that comes down the road. They're investing in maybe 10% of them at most. And then in my book, anything at 75% up to 100, those are good deals. And so between 75% and 90, there's a category of deals that are good businesses, but they're not going to raise VC money. They have to raise money elsewhere. And this makes it much more attractive. There are many angel investors who will invest on a 3x and 3 that they would not otherwise, because they have the option. Not to say that they take it, but they just want the option. So it expands the pool of money that's out there for it. Now, if you go raise all your money on venture capital, that's great. Go do it. But many companies cannot.
John,
You're looking at different companies than what most venture capital and the angels that think they're in venture capital are aiming at. You're expanding the base of companies that you're looking at.
Right. Like I say, if you take, you rate them from 1 to 100, those that are above 75 are what I call fundable. And below 75, they're really not fundable. They should just go get a loan and be done with it. And if you go to the venture capital world, they're looking at 90, 95 and above, because it's just got to be the best of the best deal and so forth. So between 75 and 90, there's a gap of good companies, but they're just not going to win VC money. VCs don't invest in 7 or 8s; they invest in 9s and 10s only. But there's still good business there for us.
And you're assuming that each individual is a standalone investor. You're not gathering a group like Seattle Angel Conference does, where we have many investors in an LLC. But each investor, when you say each investor, you mean each entity going onto the cap table separate. Is that correct?
That's right. We're not putting a fund together. We can put a special purpose vehicle together if we had a lot of people, but in most cases we don't need that. And we have people coming to us raising funding. We offer them 3X and 3. They say yes. We write a diligence report. We put the documents together and we shop it to our investors and they can join. I've had angel groups come to me saying, well, those are nice deals, but what I really want is I want you to put 3X and 3 on my deal. I've got a deal here that I want insurance on. Can you put it on there? And the answer is yes, we can do that. And we can do the facilitation if you want. In my book, if you're raising more than $100,000, it's worth doing a facilitation agreement. It's below 100,000, 225K checks is probably not worth doing all that. But that's negotiable in that case.
Okay. I saw Noel had his hand up earlier. Noel, you got a question?
Yeah, I'm just trying to get my head around this, because are you expecting, how many failures are you expecting at 3 years time? Because an IRR of 44%, that I'm all very new to this. That seems quite high. I mean, I would expect you still to see a lot of failures at 3 years, as opposed to fairly consistently being able to get 3 times your money back. I mean, why do anything else?
Well, I think there's an opportunity here for it. Now, I will say, like I said before, 1 out of 10 goes under, you lose all your money. And then I do find that when people, they redeem and I want maybe 2X my money, and then the other X goes onto the cap table, you don't actually get all 3X at year 3 in one day. You will get that other 2X spread over probably 24 months. So it comes out to be a little bit of lesser than a 44% IRR. But you're well above the 10% interest rate that some people offer on term sheets itself. So you do get a wide range, a mixed bag, and what you're looking for is fundamentally good, solid businesses that are going to stay up and running. You're not looking for businesses that are going to be sold or exited. The former of that is about 10 times that of the latter. There's, if you go and look at Crunchbase, out of 1,000 startup fundings, only 400 go on to raise a Series A. That means 600 are off the venture track right there. And only 16% of those deals will ever reach an exit. 84% will not reach an exit. So you have this huge chasm. And so I'm trying to gear this to be a good return for investors, even if you don't sell the business later. And one of the challenges is that you'll find that CEOs get too much of a salary. And one day they wake up and they do the math and they say, well, if I just keep the business for the next 10 years, I'll make more than if I sell the business. So I'll just keep the business. And now you're stranded on this equity track that's not going to happen. And they're on the payroll track. And so what I'm trying to do is follow the startup where if they decide this is going to be their lifestyle business, great, I'm right there with you. And it may not be a 44% in every case for sure.
Hey, John, I want to jump in here. You're on mute, John.
Hi, Looney. I wanted to go to you and have you engage in your context before you start diving into the details of Hall's stuff.
I wasn't going to dive into it. I was going to jump off of his 84%. Okay.
Great. Please.
And I think you're the echo, actually, by the way.
I am.
All right. So here's where I got into this. I saw those stats. 84% of venture capital investments don't return a positive return. 84% were bad investments, right? And this is from the venture capital world. This is from the best deal flow there is in the country. These are from the professionals that are paid way too much to sit there and say no all day. And they're still wrong 84% of the time. Right. So, you know, what's that? Two out of 10 times they're right. 1 out of 10 times they get their 10x if they're lucky. Most actually don't do that. When you further dig into these details, you find that 15%-ish of venture capital funds actually return more than the capital that was put in. And the rest of them, you should have put your money in a Vanguard fund, right? And for about half of them, if you had left your money in your savings account, it would be worth more. Right? Half of all the VCs can't even beat a savings account, right? Most of VCs can't beat a Vanguard fund, including 2008, right? Including 2008, 2009 in that crash, they still can't beat that. So if that's true, right, and it is, and we have decades of data showing this, why on earth would you follow them and aim for a 10x investment and put your money in a illiquid place on a cap table where you have no control over anything, no control over salaries, no control over their expenses, and hope, right? Basically, you're handing over money and hoping that you've found something that none of these great VCs are ever going to find, or rarely going to find, right? That's just madness, right? That's a bad bet. Now, you overcome this with two ways. First way is just do a lot of it. We have seen this research on real data. If you do 200 investments in startups, then you have like a 99% chance of getting your money back. And I remember the number on 200 was, let's call it a 90% chance of doubling your money. And you have like a 10% chance of tripling your money. But you got to do 200 investments. If you do 300, the odds go higher, right? So there's a fund in California, Right Side Capital, and that's what they do. They just do a massive number of investments per year. That's one path. That's what YC does. YC, we all think, Y Combinator, we think, okay, they're finding these great companies and all these people are investing and whatnot. But for YC themselves, they're doing 200 investments per year. Techstars is doing 300, 400, 500 deals per year. They're doing this model where they're just putting massive amounts of small bets out there, and enough of them are successful, right? There's 16% that are successful. So they hit a few big winners. Dropbox, Airbnb, those were all through the accelerators. Okay, so that's one path, but for most of us, we can't afford to do that because that's a very large amount of money. Right. So at the normal rate of $25,000 a piece, you got to have a lot of money to do 200 bets. Even at John's rate of $5,000 a piece, that's a lot of money to put it. It's just a lot of work. Do one at a time at $5,000 a piece. Way more work than it's worth. So if that's your alternative A, what's alternative B besides not doing it? Right? We call alternative Z is just don't be an angel. Well, alternative B is to realize that not all those 84% of the companies have failed. A lot of them are still running. They just don't have any value to the VCs because they stopped growing. So when you see that early pitch, and we as angels, especially the small angels, are going to see the earliest of pitches, right? The pre-seed and the seed investments. Those pitches, when they, one reason they're doing convertible notes is they don't know how to value their company. You don't know how to value their company. Really, their company has no value at this point. Right? It doesn't have any value till it has real revenues, right? Significant revenues. Part of it is that they're just hoping their hockey stick is somewhat true, right? Almost no hockey sticks are true. We've seen that research as well. Something like 1 in 300 companies ever even hit the numbers that they show investors. 1 in 300. So basically, when you see a hockey stick graph, it's not true. It's not even half of that. The VCs, I used to raise money from VCs as an entrepreneur. They'll usually just, when you walk in and you ask for money, they'll look at your numbers and they'll say, okay, how long can this company go if there are no revenues? That is one of the tests they did. They'll also say, what if the revenues are halved, right? How long will this company last? We got to make sure that we get at least 18 months of runway or 15 months of runway, even if the revenues aren't there. We just have to try and hope the market shows up or hope they stumble on something good. Okay, so if all this is true, then you got to invest in another method. And 3 and 3 is a fine method. I would push back and say, why are you having this conversation 3 years from now instead of now? Why don't we just have the conversation now and and come up with all the terms that we agree on now. And then we don't have to renegotiate anything later. We can just say, okay, here are your terms. Everybody's in agreement and let's run with it. So the terms we use are pretty simple and we do get to do it. One of the benefits of the way we invest is it's an accelerator. And so we get to do 7 investments at a time, basically all on the same day, all in the same week. We get to tell our investees, these are our terms, take it or leave it. And we also have the advantage that no one is coming to us for our money. They're coming to us for our help. And so even if they push back on some of these terms, they usually accept them anyway. And we also have the ability to say, these terms have been done over 100 times. We've done 105, we have 105 graduates. We've had a couple one-offs. So technically it's probably been done 98 times. So we know these are acceptable terms because they've been accepted before. And, you know, we've modified them slightly over the years, but, you know, the lawyers have reviewed these and said this is fine. And so our terms are pretty simple. We buy shares in a company. We actually put a valuation on it. We actually don't look at the valuation. We don't care about the valuation. We buy a bunch of shares. It's an accelerator, so it's $20,000 for 6%. I think I said that before. So we get a bunch of shares, whatever 6% is. And then the company is then obliged from the next quarter and every quarter after that to repurchase our shares at, repurchase half our shares for twice what we spent on them. And I'm saying that explicitly because it's actually the cash and the value of our program combined, that's the value of the shares. So we bake in a 2x return on half our investment. We don't care if they're venture scale. We don't care if they're lifestyle. We don't care where in the world they are. We do a lot of investing out in emerging markets. We just look for companies that we think will grow at a reasonable rate up to, let's say, at least $500,000 a year in revenue. More is better, but we don't care. Because the reason it's $500,000 a year is just when you do the math, we're expecting to get paid back 4% of their revenues. And they got 4% of their next 1.8 million in revenues. That gets us a 2x return. So these don't have to be giant companies. Again, we can invest in a lot of different companies around the world, and we do. Some are American companies that are getting big. Some are emerging market companies that are still small. But it's all baked in to a 2x for an unknown amount of time for half the shares. And then we left the other half of the shares for 2 reasons. One was kind of touched on earlier, which is, well, maybe some of these companies will get huge and get acquired, right? 16% of the VC companies do. So maybe we'll hit upon one of those. And the other reason is we want more than 2x. So rather than bake in a 3x or 4x or 5x and negotiate all that, we just say 2x at the beginning. Lighter Capital started with 2x. They've come down. It's smaller now. 2x just seems to be the number that everybody can agree on. It's like when you sit around negotiating to split up anything and you really don't have any meaningful reason why it's not half-half, it winds up being half-half if you've had one of those negotiations. Well, the same thing seems to be true in startup investing. If you start to try and do a 2.2 or 2.5 or 1.8, you just wind up with 2. 2 just seems to be a magic number that everybody agrees with. And to go back to Karen's question, well, why would the entrepreneur pick this? Well, 2 is an 80% discount on what everybody else wants. So all of you guys walked into this room thinking that angel investing was about 10x investing. You're supposed to get your 10x. And if you're right, for those rare times when you're right, then you're taking $10 away from that entrepreneur for every dollar you give them. That's what it means. Nobody talks about it like that, but that's what it means. So that means if you give them $10,000, then when they're acquired, you're going to get $100,000 back. That sounds great to you. To them, what that should sound like is, I'm going to give you $1, you're going to give me $10 back. The only reason nobody talks about this is that's a really good day. The entrepreneurs get a much bigger check, hopefully bigger than you, and they're happy that day. And they don't really want to fret because they're so happy. And I've had this happen to me in real life. I know how much the investors made. They did good, right? Yeah, that was my money, right? Yes, they were, okay, I want to say they were useful. They gave us some money to play with for a while. But that was ultimately, it was our money. After the euphoria wears off and whatnot, you realize that you gave up $10 per dollar when you go down the venture path. And we didn't do a 10x, it was smaller. But it was still a huge amount of money. Whereas on this path, whether again it's 3 and 3 or the seal or my model, it's less than that. So if it's $2, if it's double, then it's $2 per dollar. If it's 3x, it's $3 per dollar. That's a humongous discount. That's a bigger than 50% discount on the use of that capital. So that sounds like it shouldn't work. That sounds like the investors are getting screwed, right? It sounds like the investors are taking the hit on this. But the key is that we're not then aiming for the fences. We're not go big or go home in terms of investing in this style. We are looking for companies that can earn revenues. We're looking for companies that have customers, they can get more customers, they can earn more money, and they can share a teeny bit of that money with us over the next 5, 7, 10 years. And that will get us the same exact return that the successful VCs will get. Right? And I want to point that out. The same return the successful VC platforms get. When you do the math on the one time 10x and the 2 time 5x and whatnot, you see that it's about 2.5 times their money back. So the real benchmark, right? We talk about IRRs and whatnot, but everything in this world is measured in cash on cash return with no regard to time. I've been in the room with plenty of angels, and I've asked them straight up. I said, would you rather have, and I gave them an IRR that was high, or 2x return? And everybody in the room picked the 2x return. Probably 80% of people couldn't compute IRR and had no idea what it was. You know, big number's good, but 2x was bigger because IRR is measured in percent and 2x is 200%, right? So 2x is big. Anyway, people like cash on cash in this business. VCs tout cash on cash. Their investees may look at IRR, the big endowments, but investors want cash on cash. They want to tout that they made a 10x return or a 5x return. But what they're really doing is returning 2.5 times the money to their LPs. And if they do that, their LPs are happy. And if they return 2x to their LPs are still happy. Right? Anything better than anything between 2 and up is good, and a tiny few return 3x. Whoever was in Snapchat and what was the latest one that went? Airbnb. Whoever's in Airbnb, they did great. They did a 3x return on their fund this year. And whoever was not in that and passed on it, they probably did a 2x return or lower this year. So if you can get more companies that do return you 2 to 3 or 4 times a multiple, and fewer fail, you get the same return. And that's really what it comes down to for the investors, is do deals with good companies that you want to see keep going for a long period of time. If they happen to be acquired, oh well, you put a preference in the deal that says you get the higher of whatever they owed you on the redemption or whatever your shares are worth. Now you have a more upside, and run with that.
No, that's a good point. My question is, if you were investing in Facebook, would you want an equity stake or would you want a revenue stake? And the challenge is, 1 out of 1,000 of these is going to be a Facebook. You just have to figure out which one, and that's very hard.
And I'll say your likelihood of finding the next Facebook is 0.
So why or even something that's decently returning, something
I
that's
get it, but
equity return.
The odds of seriously, people do this example all the time. But if you go to the most valuable companies in the country at the moment, right, and you go to the Microsoft, Facebook, Apple, Google, whatever else is on that list these days, there aren't 100 of those. There are 5 or 6,
right,
in 30 years.
Mm-hmm.
40 years, right? Since 1977, there's 10. Odds of you finding one as an angel here in Seattle or wherever you are is 0. Round down to 0. The odds are, so low that it's unlikely. Personally, I would much rather have a 2x return on half of my Facebook investment and a 1,000x return on the next half than a 2,000x return on the whole thing, because I had 2x and I got it in 5 years. Or 6 years or 7 years, and I had to wait, 11, 12, 13 years for the other one. So I'll take the bird in the hand now on the 2x and let the rest of it ride.
Mm-hmm.
Right? Let the rest of it go.
So one of the questions that came up is, do people who are follow-on funders care that you have this weird deal? And does it mess up the ability for them to get the next round?
In 105 deals, it has come up 3 times. One time we just said, I know you guys think you're venture scale. We'll sign your damn convertible note. We like you. Good luck. So basically, we did Hall's deal, but we did it at the beginning.
Right.
They said they were on that path.
At 2x or below, they'll go ahead and sign that deal. They'll go ahead and take it. Above 2x, it gets to be an issue with them. It's too much money that could potentially go out to other investors. They don't mind paying off the previous angels, but they don't want to pay them too much. And my rule is around 2x is not an issue with it. And if you have investors that still want an equity stake, well then you'll be take 2x in a cash return and then 1x for equity just in case it's a good return in that case. And so now you get both. But you're right. If you raise too much on debt, you make it difficult to raise follow-on funding. But I think we're below the threshold in many ways.
Yeah, but again, it's shown up almost never. The other one we had was this investor just came along and said, your deal's complicated. We don't like it. I said, well, just buy us out. So here's how much we just spent. We're trying to make a 15, 20% IRR. Mm-hmm. All right, we'll take that in 3 months instead of 5 years. We'll take that deal, and they bought us out. And I'm actually, in the end, they didn't get along with the investor. I'm hoping to buy them out now. It's been 5 years later, and I would love to get them at their cost. That's my deal that will be put on the table later this year.
Yeah. So you've done this a bunch of times, and you think that this changes what companies are investable, and you sort of wave your hands and make a big circle. Can you think a little bit about this? What kinds of companies or what percentage of companies? Hall is saying 25% of companies are investable. With your model, what percentage of companies are investable?
I don't know that. So we can go to the Kaufman SBA statistics that say half of companies fail in 3 years. So half the companies shouldn't be investable. They're going to fail before they pay you back.
50 and below, don't touch.
Yeah. Everything above that, I don't know. We don't have any other statistic for, okay, what's the survival rate in 5 or 7 or 10 years? I've not seen that. If I had that, that would be the number. And then the question isn't which ones are investable. The question is how much money could possibly be invested in those companies to get a decent return. And so for some number of them, let's just say they're earning, $200,000 this year and they never grow past that. Well, that wasn't a terribly investable company. Not just because they didn't grow, but probably, if they're paying their bills and break even and doing 200K, there's just no money to be shared there. And then there's going to be some out there that are, even if they grow, their margins are so thin. So maybe they have, 5% net margins. They really shouldn't be sharing all of it with us in a revenue share. And half of it probably just doesn't pay us back in any reasonable time. So what I've seen is that lots of companies are investable, but then I'm limited in the amount of money I have. And so I mostly have, a plethora of too many good choices. I have the opposite problem of VCs. Too many good choices, not enough money to invest, as opposed to, saying no to too many companies.
So we have a lot of new investors that are participating in SAC, and some of which are here. And they think, when they think angel investing, they think equity, right? And what you're presenting is you can get, instead of the small amount that venture capital invests in, you can get this 25 to 30% of companies are investable. And the probability of you getting 3x your money is better in some sense than randomly picking a venture fund.
Yes.
Is that a good way to frame it?
Yes.
Yeah. And so you do this Fledge thing, not only in Seattle, but you have affiliates around the world. You want to tell people a little bit about that and a little bit about your Realize fund?
Sure. So Fledge started here in Seattle, used to run 2 programs a year, just like SAC. And we did that for about 4 years. And then I had a whole bunch of incoming requests from people around the world saying, I like this model. Like, I like this idea of an impact accelerator. Can we do it where we live? And so we started teaching them how to do it. And I lost count. I think it's 11 partners, and we've done it in 8 cities so far. I don't know, we've done 17 sessions. We're falling behind SAC, but we'll catch up soon. And some of these partners,
if I can help it.
Yeah, I'm working on it. Some of these partners are a little more specific. Fledge Seattle will invest in any company anywhere doing anything impactful. Start.coop is in Boston. They'll only invest in scalable co-ops. Land accelerators in India, Africa, and Latin America. They'll only invest in restorative agriculture companies. And then there's some others. Some other work I'm doing.
Some of these are in places where there's really no effective angel market, right? There's
We've
not really a
invested
place
in,
for them to go.
yeah, we've invested in companies in 24 countries. I believe we're the only early stage investor in the country of Botswana. I can't find another one. I have an awesome company there. I send them money all the time. I keep sending them more money because they keep growing, and I can't find a co-investor. I don't believe there is one. When I invested in Malawi, I found 2 other investors who had ever invested in Malawi. Now I know of 2 others. So there's 5 investors in the whole world in Malawi, and institutions, no individuals. We have investments in Ethiopia and Philippines, in India and Argentina, crazy places around the world.
So Kate wants to know a little bit about what the deal terms are when you go to invest these crazy places around the world.
We don't change the deal terms. We invest in dollars. We invest in the companies wherever they are. We don't invest in companies in countries that don't have governments. We tend to invest, because we speak English, in countries that used to be part of the British Empire. So nearly all of our investments are in common law countries. The contracts are the contracts. They look the same and act the same. A lot of people push back and go, oh my God, all this risk of investing overseas. I don't see that. I have far less failure rate in emerging markets than in the US.
So I was hoping you would talk a couple sentences about the Angel Accelerator that you're doing.
Yeah, thanks, John. All right, so inspired by SAC, last year, Fledge launched the first ever Angel Accelerator. So the idea was twofold. One, we wanted to create a program for those of you who have done SAC 3, 4, 5 times and want to go deeper. The program we do is still hands-on. You still do investments to the end, but we have a lot more lectures and workshops and content like this. And the second thing was we wanted to prove out that we could fund a startup accelerator with an angel accelerator. And so we did it last year. We had 14 investors join in. It's $10,000 a ticket plus the fee. So last year it was $10,500. This year it's $10,700. And it was fun and it was great. And we're doing it again. So last week we launched the next 2 angel accelerators. So we're not just doing this in Seattle this time, and we're not completely tying it into the startup accelerator this time because there isn't one running right now. So we have 2 programs that launched. One is US focused, US investors funding anything, anywhere. And then the second one is funding Africa. 2 time zones. So one set is at 9 a.m. our time, and the other one's at 6 p.m. our time, Wednesdays. We'll put it in the chat window, theangelaccelerator.com, if you're interested in that. And we're doing free workshops for the next 6 weeks. So if you want more of this kind of content, come on Wednesdays, 6 p.m., hour and a half. And then the other thing I have on my plate, one more hat, I'm a hat collector here, is called Realize Impact, which is a Bainbridge Island-based nonprofit. We launched a service last year to make it really easy for anybody with some philanthropy to make impact investments. So impact is my common theme here. And what's that mean? So there's a huge pile of money in this country locked up in things called donor advised funds. If you've had an exit, you may have seen these before. The largest of these are Fidelity Charitable, Vanguard Charitable, Schwab Charitable, Silicon Valley Community Foundation, Seattle Foundation. and a bunch of others. About 2,000 of these in the country. Basically, you donate money to them. They're a charity. They then put the money in an account that looks like your money, looks like you have control over it, but it's their money. And then you can donate out of that account. We now have a service where you can donate to our charity, Realize Impact, and recommend an impact investment. And then we'll do the impact investment for you. And then we will monitor it and guide it along. And when something comes of it, we'll send 99% of it back to your DAF. So we did about 3 million of donations last year using that new service. And we did it with every major DAF that exists in the country. That was really a lot of fun. So this is another method for de-risking your investments. So when you come across something you really like, has to be impactful, but you come across something clean tech, good for the environment, good for society, Black Lives Matter, anything along these lines. And it's really nice, but you don't know whether it's going to succeed. You don't know whether it's going to be one of those 16% or it just looks good and you want it to happen and you don't care whether it returns or not. You can turn to a donation. You can use you can use your DAF, you can use fresh cash, you can use appreciated shares, right? Stock market's at an all-time high. You can give us a share of whatever, Amazon, Boeing, Microsoft, whatever, and we'll do the investment. And if anything comes of it, you now have more money to give to charity.
And that's called renewable capital, renewable, the legacy capital, or
we came up with our own. We called them a FIGs. Like everybody I wanted a four level acronym as well. It's Philanthropic Investment Grant. FIG.
There you go. All right. So Hall, you have this thing that has a time limit on it, and Looney has this thing that doesn't have a time limit on it, but you're both taking a multiple. He's taking it as a percentage of revenue. You're taking it at a time point. Bryant, you have a completely different knot that's sort of halfway in the middle of those. Can you sort of describe that thing? Because I think these three models have three fundamentally different shapes when it comes to how we get the money out. So how do I get the money out of Earnest Capital? I've got a deal and it's coming back to Earnest Capital. How does that work?
Yeah, well, so the seal again is really based off of how the safe looks. So there's the revenue component, which these revenue payments are being made periodically. And then there's the equity conversion component. So, I guess one kind of exit scenario is you as an investor will just sit there and collect your periodic revenue sharing payments, assuming the company has hit the thresholds that you've set in order for them to start making the payments until they hit the repayment cap, which is like 2x or 3x or whatever you negotiate. The alternative is you forego basically those payments in lieu of converting it like a safe into the next fixed price equity round, in which case then you're just sitting on the books like a preferred holder, and then you're kind of along for the ride there. So yeah, I mean, those are kind of the two, I would say, cases that you'll see in terms of the economics there.
So there's not a time limit on the redemption. It's just a percentage like what Looney does. But then you have this conversion into stock where you convert an arbitrary percentage into stock, right?
There's a mechanism. It's a formula based thing that's, it basically calculates your equity basis. And so essentially the founder, as they make payments, can claw away your ability. I mean, the maximum end, you can use the total amount they owe you. So it's their principal amount with the multiplier on it to invest. However, as the founder is making payments and stuff, they're obviously clawing that back. So the formula takes in payments into account. Though this particular model kind of does what NDVC does, where it hits a certain point where you can't be redeemed out. So the seal is ultimately, even if you've made payments almost all the way, is convertible into some base amount of equity if you want. So it's kind of like an equity kicker almost, is how it ultimately works out.
So one of the things I worry about as I get into these small angel investments is the overhead of managing whatever it is that I've just done. And so, I get the stupid K1s and all of the other things that I don't like. So for each of these, if we could go real quick around how much overhead is there for keeping track for the duration of this investment of the details of what you just said. How many hours are we going to end up spending dinking with data in order to keep track of how much money we get paid each month or each quarter or each year?
This is why I
Right.
like quarterly repayments, because
Yeah.
there's 4 of them per year instead of 12. So that's one way I take care of this. And then because I have a lot, dozens and dozens of things, I do them all at the same time. So, the deadline is 15 days after the end of the quarter. And then I start sending out emails. So it's a way
And what-
more work than a equity investment, but to actually get some money back. It is no more work than following up on a loan. It's the same basic structure. Hey, you owe me some money. The only difference here is, okay, how much did you earn so I can compute how many shares you buy back, as opposed to, here's the payment you owe me. Where is it? Have you sent it yet? But otherwise, they're very similar.
But Hall is even dropping the overhead way down, right? He does nothing for 3 years, then he makes a decision, and then he gets paid out in whatever way he.
I think you're
right?
misconstruing that, because there's nothing for 3 years, and then it's basically the same deal as I have. Now you're following up to get paid.
Right. It turns into a revenue share at year 3. The key is you want an out mechanism if you get to a place where they've decided they're not going to keep trying anymore. And that's a lot of the time. And that's one of the biggest challenges with angel investing is they just stop working on it after a period of time. But here we actually do a facilitation agreement for investors because they wanted information rights. I want my reports, and the entrepreneur's not very good at getting us. Okay, well, we'll get in there and have access to the bank account and these things to give you those reports, because that's just a benefit to the investor, because the entrepreneur's busy with
So to
other
be
things.
clear, you sell as a service the management of the thing, right?
Right. And so if it's over $100,000 investment, like I say, 225K checks, we're not going to worry about that. But over 100K investment or more, we'll come in and we'll offer a facility management service to the investors to give them the information rights, monthly, quarterly, whatever's appropriate. And then it's the same thing as Looney says. It really isn't much time to go and look at the bank account, print the report, send it out. We're done. And now we have access to what's going on inside the business itself. There are some businesses that after a few years, they do want to kind of pretend that never happened and they never paid you. And so you want to have the ability to go back and, yes, you did. And, we have to move forward with this.
Yeah, actually, I want to jump in and say one reason why my terms are you start redeeming on the quarter after the investment is just to get them in the mood and in the cadence and experience of that's what we do. And so, it may be a tiny payment, and more often than not, I will forego the first payment. I will say, okay, you owe us $342. Don't pay it now. We'll deal with it next quarter.
Right.
And
Most investors think they want legal control. What you really want is operational control. You want to be in the bank account. You want to be in the QuickBooks. You want to understand what's going on, because now you know how the negotiation is really going. Some people say, well, I have a contract. It says it gives me information rights. Well, what if they don't give it to you? You're going to sue them in court? Well, no, you're not. So you just go without. Here, if you get operational access, now you get information rights. Now you know what's going on. And that's a huge advantage in understanding the business that's going on. Because some people, hate to say it, are just not up and above about what's going on.
Yeah. So I know that with Lighter Capital, that they intentionally sort of stick a probe into the QuickBooks and actively manage the details of that on a daily basis. And you're doing that by hand. Am I getting that correct, Hal?
That's right. We're just looking at, what are the income statement balance sheets look like, send it to the investors. What's cash flow looking like? Because investors always ask me that. How's it looking there? And you can go to the entrepreneur, but you find that they're just super busy with the business. They don't have time in itself. Well, we can do that for you. And I found that was a value added service a lot of investors really appreciated. And to Looney's point, you have to be in there up front. If you wait 3 years, you're going to have a hard time getting back in there. So before they get the funding, they have to sign a facilitation agreement. We have to have access to the bank account. Okay, now we can go forward and fund it.
Okay. And Looney, you do all of that by hand as well, right? You watch their revenue because they send you reports every month.
And so this is one of the advantages of running an accelerator program versus just being a standard fund manager or angel is that we bring them to a city and work with them for 2 months. So we create a relationship with our investees, and because of that, and contractually we have information rights, but because we created the relationship, then they're sending us the data. Then they're sending us what are the revenues. They're sending us a lot more than that.
But you don't have your fingers in their QuickBooks.
At the moment, no. And at the moment, a lot of them don't have QuickBooks. There's no place to plug in there. But we're working on. We're working on how to teach everybody to get on a system like QuickBooks.
I was going to say, with some of the revenue loans, I mean, it's not just a matter of having visibility into someone's QuickBooks. I mean, oftentimes controls are built in where, you can actually make withdrawals and stuff from, the accounts itself. So, I mean, but those are usually the bigger revenue loan deals. Just Ernest, for instance, is just kind of NVCA style information, right? So really there's a certain amount of financials that are just described and they have to be provided, and a couple other ones in there, but there's no visibility into someone's bank accounts. And a lot like Looney, I think Ernest has some sort of accelerator component that they utilize. So again, I mean, and Looney mentioned this earlier, I mean, there's this kind of ongoing mantra, right, of like, well, how are you going to make your return? Are you going to go for the shotgun approach and just get as much money and capital deployed out there as you can and aim for that 200 investments in order to, hit your economics? Or are you going to do those, smaller number but more high quality deals? And Ernest is definitely trying to use these revenue loan type things, but they're going more for the scattershot approach. So, because of that, they're not as in the business of the companies, because I think they're fully expecting that a good number of them are going to fail. So their idea more is to form good relationships with them through their accelerator. They have their information rights backstopping it so they can look if they need to, but it's definitely not as robust as it can be. So.
I know that Right Side Capital has a round that they're opening up right now. So there's an opportunity to get into that shotgun approach of investing for those that like shotgun investing strategies. But you have insights, Brian, into Right Side, or not Right Side, Lighter Capital, as well as into Earnest Capital. Can you talk a little bit about the structure of the fund and what a rolling fund is, just so we have a definition of a rolling fund?
Yeah. So I guess this is a little bit of a departure from what we were previously talking about, but the rolling fund is a structure that we helped create for Ernest that kind of serendipitously, or kind of right around the same time, Angel List also came out with and kind of popularized. But the concept behind it is funds are structured in such a way that you can only have a certain number of limited partners, and there's also kind of constraints with who those limited partners can be. That's why I don't know if any of you have invested in a fund, but a lot of times they're looking at you, if you're investing through an entity, to look through the entity to see who the beneficial owners are. And the reason why is because it's called a 3C1 fund. You can only have 99 and they all have to be accredited. There's all these other exemptions promulgated by the Jobs Act that allows you to have up to 249 limited partners and then one general partner. If your fund's AUM is under 10 million. So that's like kind of another one. But again, there's a limit on how many people you can have in your fund. 3C7 funds, unlimited, but you have to be a qualified purchaser, which is basically like a super accredited investor. So the net worth amounts are a lot higher. I think it's like 5 million. And anyways, what a rolling fund tries to do though, is it kind of tries to address this issue that The venture asset class, just by virtue of the fact that you have a limited number of seats in any given fund, really makes most funds skew towards bigger check sizes because, again, like Looney was saying earlier, if you're going to do 200 deals a year at $30,000 a check, like you need a good amount of dry powder in order to do that. And you're not going to get that done with, $10,000 checks from accredited investors into your fund just because they're going to take up a seat. And ultimately, you're not going to have enough dry powder to execute your investment strategies. So what a rolling fund is it takes a few different rules and attempts to make it so that it's a little bit more accessible to smaller investors. And how it does that is basically by spinning up annual funds. And so what happens is an investor that wants to get into this structure goes into the generalized rolling fund structure and commits to invest some amount over a period of time. And usually it's in quarterly installments or something like that. So if you're an investor in a rolling fund, you'll say, hey, I'm going to contribute to your fund and I'm going to do $100,000 total split out over 8 quarters. And then what happens is usually the funds will live for about a year. So for those quarters that you've committed to, cut a check, will go into fund 1, and then it'll only invest for a year and it only has a year period of investing. And then after that, that fund will cease its investment term and then a new fund will be spun up. So the fund 1 won't cease, but it stops investing and then a new fund starts investing and then your money and your subscription rolls into that. And so what happens is, I guess just trying to condense this as much as I can, is because we have this structure where the funds are kind of consistently raising and funds are spinning down and spinning up, it allows for these smaller check sizes to be facilitated just by virtue of the fact that there's more funds and being used and there's more opportunities and you're not as limited by the 3C1 limitations on 99 investors or the Jobs Act one. Though again, you have to raise under $10 million in order to take advantage of the Jobs Act LP count of 249, which a lot of strategies struggle with. So yeah.
Cool, thank you. That was really helpful. So I see Kate put a note in there. Kate, you want to ask your question?
Yeah, just for Looney and I guess for everyone who's presented just now, it'd be really great to hear any additional resources that you have, particularly, as some of our investors that are here tonight are brand new to angel investing and just getting started with understanding deal terms. Some of them might be more seasoned, but I think especially for people that are really new to this process, if you have any resources for how to get started with, kind of engaging in this process, that'd be great.
Yeah, John, are you not doing Angel Investing 101 again? Again?
Yes, we are. We're doing the Angel 101 later on. We will definitely go through the basics, but I think Kate is looking for the next step of diving in and trying to find resources we can put on the sides of that 101.
Yeah, so I'm going to go back and I'll tout it one more time. In the Angel Accelerator, we're doing more lectures. If you come to the website, there's a lessons page. And on there is a recording of John teaching Angel Investing 101 inside that program. And then about 4 or 5 other lessons as well. We have recordings from all of our sessions last year. They're just not all edited yet. The plan has been and will be to get those edited and stuck on those website, free for everyone to consume. So Angel Investing 101 and 201 and portfolio management and fund management and due diligence and a whole bunch of other deep topics. And that's the best resource I have for this other than some books.
Yeah, we have a term sheet that we put together that's on our website that describes just the very basic terms. There's 125 terms in the MVCA directory, but I find that a bit overwhelming, so we won't go there yet. But you can find the basic ones in our e-guide there, free download and whatever, right?
And I'm going to give you the wonk answer, but I just linked 3 different URLs in chat. One is Cooley's note, which honestly is probably like the most standard form note you're going to see in most places. You'll see some variants on it, but a lot of them are riffs on the Cooley note. So there's a term sheet in there. Term sheets are like a really good thing to look at because that's like the truncated terms that are just like the real high level, like that's what you negotiate, and then your lawyers will populate the notes for you. So look for term sheets. There's one on the Cooley one. I uploaded the safe. They have a good explainer on Y Combinator of what the safe does, but you can just read the safe. And then the other one is I linked Series Seed, which is like kind of a, so NVCA is the document set that you're going to see a lot of deals on once you get to the A kind of stage, and then they usually get more complex from there. Series Seed was an attempt to kind of make an easier to understand preferred stock financing round. So on that link, there's a term sheet and a certificate of incorporation and a SPA that you can have a look at as well. That'll kind of show you like, here's the note, here's the safe. Those are kind of the first vehicles you're going to see, with the hope that eventually it'll turn into a fixed price round, which the Series Seed kind of represents. So I'd go check out the term sheets and all that stuff.
And I would go take that one step further and say, because you can get the Series Seed, the whole docs are up there.
Yeah.
So the term sheet's nice. Start there. And once you kind of get that, go read the actual docs. It's only like 15 pages.
Baby steps, Looney, baby steps.
Yeah, but these are people, some of these people have done SAC a few times. And the reason why I tout this is that when you go out there and you're joining in a deal that someone else has already led, or you're not the first investor, you're gonna have a doc thrown in front of you and said, okay, sign this. And the more docs you've seen, the more actual full scale docs you've seen, then things just look normal. So I see Series Seed and I don't see it, and we've used it a few times in my companies. Everything looks totally normal in there. And nothing jumps out as crazy. Whereas when I've co-invested with some other VCs around the world, I've seen some crazy stuff in their docs. And the only reason I know that is I've seen so many docs that it jumps out, and I say, well, I don't understand. Why would you put this in here? And then I have to go and jump on the other side of the table and advocate for the investee. And protect them against the nasty VCs. So it's good to know what the good terms look like.
Yeah.
If anybody wants to see what the 3X and 3 looks like, we gave a copy to John. He has it. He can distribute it to you if you'd like to see what the actual convertible note looks like with the terms.
Yeah, and I was just going to say,
sure if you wanted me to post that or not, and so I kept it, but I'm glad to share it on a one-on-one basis unless you're willing to let me post it.
You're welcome to share with this group any way you like. Yeah.
Okay, great. Thank you.
And I was just going to say, I mean, if any of you are looking at these things and you just have general questions, I know myself and Joe Wong, I mean, we talk to people all the time about this stuff and love explaining it and helping people out. So, I mean, to the extent you guys have any questions, feel free to drop me a line on LinkedIn, or I think my email is in there somewhere. So feel free.